Very good morning, friends. So I hope you're all doing well. And as I keep asking you every class at the beginning, that I hope you made your revisions. That means cumulative revision. Because as I had, requested that financial instruments a little complicated affair. So what you need to do is when you've done with the second class already, the expectations are that you've made your revisions of the first and the second class put together. Well, I also have a constructive obligation. As I said, every start, what we're going to do, we're just going to make some quick mind maps on the previous learnings and then take the journey forward. So far, our focus has been on Index 32. And in Index 32, our focus has been on the issuer perspective. We've decided with a three-step model, and I've also given you a couple of three charts as well, wherein you decide that the instrument is a financial liability, or it is an equity instrument, or it is a compound financial instrument, or I would now call it as another fourth one that is called hybrid instrument. Each class we are adding a new element of instrument into the classification. So no worries, I'm just going to make some quick inputs of a mind map as well. So as I said, your mind should start working on that there are basically four categories of instrument effectively if you see from the point of view of the issuer. So I think let's pen this down in the small mind map as well. So just creating a small mind map on the learnings which we've taken in the previous class, and you'll connect it better provided, of course, you've made your revisions on what we have covered in the previous session. So I would say that if you start looking at the classification, of a financial instrument from the issuer perspective, if I start looking at the classification of a financial instrument from the issuer perspective, I would say let's consider the broad categories in terms of, you can say, four areas. So one is that based on the three-step model, you decide it is supposed to be an equity instrument, or you decide it is supposed to be a financial liability, or you decide it is a compound financial instrument. Effectively, in these three cases, we are saying that it is supposed to be non-derivative in nature. So we're saying this is non-derivative in nature. So the broader category to say the instrument is that it's non-derivative in nature. And the other one is what we call hybrid instrument. The other one is called an hybrid instrument. And when I say it's a hybrid instrument, I would not say that it is a derivative. I would say it's a derivative and a non-derivative combined. I'm not putting in this list a pure derivative as such. You can if you want. And this becomes a case which is supposed to be a non-derivative, and there is a derivative which is embedded in the instrument. So I think it'll be more appropriate to use the word that this hybrid instrument is a one where there is supposed to be an embedded derivative. So this is the broader category when you start looking at instrument from the issuer perspective. Four broad categories. It's either an equity instrument, or it is supposed to be, you can say, a financial liability, non-derivative, or you can say it is compound, which has got debt equity, FL equity elements both, or there is a derivative embedded in the instrument. So it's called a non-derivative as well as a derivative. Now, in this particular case, let me first of all tell you that if you are considering the mode of payment to be cash, so we just need to be careful on the elements without complicating the chart. I'm just putting some basic inputs out here. How do you reach the input that it is supposed to be, either of these particular categories? So when you consider the mode of payment could be in terms of cash, or the mode of payment could be in terms of shares. The company uses its own equity shares as a currency note in terms of discharging the obligation. Now, if you remember clearly, I made it very clear that if your mode of payment is cash, I am not concerned whether it is derivative or non-derivative in nature. So when your mode of payment is supposed to be cash, it does not make a difference whether it is derivative or it is non-derivative. So let me put it like this. In this case, the segregation of derivative or non-derivative is not required. The segregation of whether it is derivative or non-derivative is not required if the mode of payment is supposed to be cash. You just need to look at those terms: mandatory, discretionary, redeemable, irredeemable in nature. So your focus is going to be simply looking at the terms mandatory, discretionary, redeemable, as well as irredeemable in nature. Now, there is one pending issue which reminds me, illustration number 3, where I said we're going to talk a little more on the perpetual debt. And I said we're going to talk that in terms of CFI, so don't worry, that pending issue gets discussed today. Now, if the mode of payment is shares, then definitely we need to consider, then we can say it is definitely relevant in nature, whether it is a derivative or it is non-derivative in nature. When it is supposed to be non-derivative in nature, we need to apply what is called the fixed test. And that decides the status, whether it is supposed to be equity or financial liability or CFI. But when it comes to a derivative and a non-derivative, to the non-derivative, you apply the fixed test, of course. And as far as the derivative element is concerned, you need to apply the fixed for a fixed test and then take a call. So that's a quick summary, or you can say a mind map, which puts things together, that when you're looking at an instrument from the issuer point of view, you need to get very clear there will be 4 categories of instruments. Now, let me also put one thing very clear. Today, my focus is on the compound financial instruments, or they could be hybrid instruments, which are CFI. And let me also connect another dots to you. I also said generally, I think let me pen that down as well. I also gave you some inputs in this case as well. That is, I'm putting it as a note. And I think to be very safe side, I'm putting that as generally. If a company issues an optionally convertible, if the company issues an optionally convertible instrument, if a company issues an optionally convertible instrument, now you would recall we decided something. The interest rate which a company pays on an optionally convertible instrument is generally less as compared to a non-convertible instrument. So we decided that the option would mean 2 things. One is it would land up being a compound financial instrument, and the options will mean that there is a derivative inserted in the instrument. Giving the option would mean that there is a derivative embedded, and since it's an option, the coupon rate is going to be less as compared to non-convertible. So this is undoubtedly, going to lead to a case where it becomes an hybrid instrument, which is supposed to be a non-derivative plus a derivative element. And we also decided something more as well. And what we decided in this particular case is if this derivative meets the elements of equity characteristics, it is not segregated. And if this derivative meets the characteristics of a financial liability, then it is segregated. So that's also what I gave you, but I did not give you any deeper logics. I just said, just remember that if the derivative has got equity characteristics, it is not segregated. And if it has got a liability characteristics, then it is segregated. That detailed discussions we've done. So I think that gives us a quick revisions of our learnings in the previous class. This is one focus done. Now we are going to go to the next agenda, and that is my deeper agenda today. I'm going to focus completely on the accounting of compound financial instruments, giving you different types of compound financial instruments so we get a complete idea that what are the various ways in which CFI can be created. And in between, of course, we'll take the discussions in terms of those hybrid kind of instruments as well. Then there are some special issues which pertains to the compound financial instruments as well. Let's begin the journey. Okay, so let me take this further now. And now we're going to discuss our inputs today on CFI. At the very start, there is something which comes to my mind. And I think I'm going to do my discussions in 3 bits and parts. So why do you always land up discussing 3-step models or dividing your discussions into 3 parts? Well, I think that's just a chance that, my mind starts working on everything on a 3 steps in this case. So let me just give you my chain of thought, how I'm going to proceed today with my discussions. In terms of a CFI, my first focus is how do you identify a given instrument as a CFI? You need to decide the parameter number 1 is when you look at an instrument, how do you reach a conclusion that it is CFI? That's going to be my focus number 1. My second focus will be in all these kinds of CFI, I want to look at the detail accounting. I want to see that, okay, if these are the CFI, how do you do the accounting, which I gave you a nomenclature called split accounting. So my second focus today is going to be looking at the split accounting of CFI. And then I'm going to go to the third issue, and that is the special issue, where we've got concepts like what we call early conversion of a CFI. There might be an early settlement or an early conversion of CFI. So what happens if there is a premature, or you can say before the maturity date, there is either a settlement or a conversion of a CFI. So focus, I'm going to go one by one on the 3 agendas. How do you decide it is a CFI? Focus 1, agenda number 1. How do you do the accounting of a CFI, split accounting, agenda 2? Then there is special issue, early conversion of CFI, that's agenda 3. I hope you get the dots connected with me. Let's now begin the journey. So I'm going to start with my discussions on the agenda number 1. So our focus is on the compound financial instruments, and my agenda number 1 is how to identify that financial instrument is a compound financial instrument. Now you will say this is what we've already covered. That's what you've been teaching us in the last 2 sessions as well by a 3-step model. Yes, but I want to just, revisit them in a consolidated manner. I want to look at which kind of non-derivative instruments and which kind of embedded derivative instruments could turn out to be a CFI. Okay, let's now give you some inputs. Now you have to decide, friends. You have to decide in this case. I'm going to give you a chart. We'll see practical illustrations as well. No worry. So what I'm going to do, I am going to give you some combinations. I'm going to give you some combinations. And in this particular case, the combinations which I'm going to give you is broadly in 3 categories. I'll give you a combinations of instruments which are non-derivative. I'll give you a combination of instrument which is derivative plus non-derivative. That's what is called embedded. So I'm giving you, you can say situation 1 here. I'm giving you a situation number 2 here. So these are non-derivative instruments, mind you, non-derivative instruments where I'll give you examples of a CFI. I'm just, connecting the dots earlier done. And then I'm going to discuss only one situation, which is a derivative plus a non-derivative put together. That's embedded derivative. So let's give you some, inputs at this stage. So I'm going to give you some facts of the case and you have to decide. I'll give you the facts of the case and you will decide that is it supposed to be a CFI or not. Let's consider a company issued a mandatorily convertible instrument. Please apply your thoughts carefully. A company issues a mandatorily convertible instrument where, as far as, so I've issued a MCD. I've issued a MCD, mandatory convertible debenture. Let's call it as MCD, where I'm giving you the inputs that in terms of the mandatorily convertible instrument, the interest, as far as the interest is concerned, it is mandatory. It is mandatory and is going to be paid in cash. Would you like to decide what is this element? Equity, FL? Please take your calls very carefully. So I'm saying there is an interest element which is mandatorily paid in cash. This is going to be called as what? Is it going to be called as FL or this? That's rightly said. This becomes a financial liability. Great. Now, as far as the principal component is concerned, this is supposed to be redeemable and it's going to be given in shares, which is fixed in number. So this is going to be given in shares, which is fixed in number. So I think you would like to decide that what will be this component. The principal is redeemable and is paid in fixed number of shares, then this is going to be equity. Wonderful. And I think goes without saying that once you add these two elements, it becomes a CFI. So which means you can have a compound financial instruments where one of the component becomes an FL and the other component becomes an equity because we are making a payment in terms of cash for the interest, which is mandatory. And the principal is paid in fixed number of shares and therefore it becomes a CFI. Okay, let's consider another example. Now I am considering a case where there is a perpetual debt. We'll be talking of this very soon in more detail. So let's say there is a perpetual debt. A perpetual debt means that the principal is irredeemable in nature. The principal is irredeemable in nature. So I am considering that as far as the interest is concerned, the interest is mandatory and is being paid in terms of cash every year. So I think you'll definitely agree that this is financial liability in nature. But as far as the principal is concerned, this is irredeemable in nature. And I think you would still like to tell me that if it is irredeemable in nature, then I think this element remains technically equity, correct? This is what we can say is technically equity. So you can decide that one of the components is FL and the other one is equity. Wow, you can see the distinction between the situation 1 and 2 clearly. In the first case, I am making the interest in cash and the principal in fixed shares. In the second case, I'm making the interest in cash and the principal is not being paid. So giving fixed number of shares or not giving a payment makes it equity and therefore the instrument is CFI. Wonderful. And now let's come to another agenda as well. And the third agenda, which I have already discussed previously as well, is a case where there is optionally convertible debentures. What you can say is OCD. It's not that it's always optionally convertible debenture. It can be optionally convertible preference shares as well. It could be OCPS. So this could be MCP, mandatorily convertible preference shares, MCPS. This can be, OCD or an OCPS. That depends. Now, we've already said very clearly that if there is optionally convertible, the interest rate is always going to be less as compared to the interest rate on non-convertible debenture. Because the company would never land up paying an interest on a debenture which is got a convertible option at the same rate which prevails on a non-convertible instrument. Mind the words. So therefore, as we said earlier, this definitely means it'll lead to a CFI. And because of the option, there is a derivative element. And this makes it a case of, you can say, a hybrid compound financial instrument. So because of the fact that the coupon rate on the convertible, optionally convertible debenture is going to be less as compared to non-convertible, so there is definitely a presence of equity making it a CFI, and the presence of the option to convert makes it a case of a hybrid compound financial instrument. I hope, friends, I'm absolutely clear on my thoughts so far. I hope I'm absolutely clear. Let me see if there is anything which is coming so far. I think I've got some wonderful answers coming in, and I think that's perfectly fine. Great. So just look at this chart for the time being so we can start working on the agenda number 1. So I've just tried to pen my thoughts in terms of the journal categories of instruments which are CFI. Mind the words. I'm just, trying to pen my thoughts that, when I look at a CFI, I start looking at instruments which are non-derivative in nature, in which case they can become CFI. Where I said in one of the cases, the principal is paid in fixtures. In the other cases, I said the principal is irredeemable in nature. And I said the third one is the hybrid instrument, where the presence of an option creates a derivative. And you can say the coupon rate on a non-convertible is generally more as compared to option to convert. And that creates a compound financial instrument, the presence of equity. Okay, now what we're going to do, we are going to just go and look at some illustrations in the study material in unit number 3 and just see that they are compound instruments based on our understanding. Let's proceed. So I am first coming to the illustration number 25. That's extension of the illustration number 2 in the previous unit. I'll just, I think, crop this so that it is visibly clear. So these are extensions of the illustrations in the unit number 1. This is extension of the illustrations which we are seeing in the unit number 1. So even that illustration number 3 is just going to come at this stage. Now watch this carefully. Let's have a look at the illustration number 25. So we can see the name. It says redeemable. It says redeemable, and it says discretionary dividends. Would you like to decide at this stage itself that if the mode of payment is cash, what do you think? This is going to become a case of CFI or a case of FL or equity. Just decide with the names. I'm sure, very confident you can decide that because we already decided that earlier as well. So just see that it's redeemable and it's discretionary dividend. Redeemable means the principal component is supposed to be paid 100% in cash, unavoidable obligation. Discretionary means that that is supposed to be an equity element. So does that make it a CFI? That's brilliant indeed. We've done this illustration earlier as well, and I think I get wonderful answers on that. Great. Let's still read. It says X company, the issuer, issues debentures to Y, the holder. The debentures are redeemable at the end of 10 years from the date of issue. The interest is payable at the discretion of the issuer. So when this is redeemable, undoubtedly it becomes a financial liability. When the dividends are discretionary, it makes it equity instrument, and put together, it becomes a compound financial instrument. I think even otherwise, though the mode of payment is cash, so I need not decide it's derivative, non-derivative. But just for your understanding, you can appreciate that it's a non-derivative instrument in nature. Okay, then it says, examine the nature of the instrument. Now, I think some of my friends asked me, so you have not till date explained this particular part as well. Today, I'm going to do that. I think that question has been pending for quite some time. And I said, I'll come to that at an appropriate time. You're going to get the answer today for this as well. Then he says, examine the nature of the instrument. Now, the instrument has got two components. There is a mandatory redemption, and which is for a fixed amount at a future date, and there is an interest payable at the discretion. The first component, which is mandatory redemption, is a contractual obligation to deliver cash, and it cannot be avoided. Therefore, this component becomes a financial liability as decided. The other component, which is discretionary interest, is an equity feature because you can avoid making a payment. And therefore, in this particular case, the instrument is concluded to be a compound financial instrument. I think this falls in my non-derivative, somewhat like situation one. Though in situation one, I gave the principal in fixtures, but in this case, you can say one of the components has got to be equity. So it's not that the situation one, which I gave you, is the only situation. Because in situation one, I considered one mode of payment as shares, another one as cash. In this case, the one component is mandatory in discretion, so that can also be the case, but it's non-derivative in nature. Okay, so let's proceed further. I think this one should be pretty much clear. So I love your way of teaching. Beautiful. Thank you. Thank you very much indeed. That encourages me to give you something more. Thank you very much. Let's go to the illustration number 26 now. Now, I think we come back to the agenda, which has been waited for quite some time. It's a perpetual loan with a mandatory interest. I think you'd like to decide, isn't that something similar to my situation number 2, which I gave you? That it is supposed to be a mandatory interest and a perpetual loan. So the interest element is FL and the principal is supposed to be equity. Isn't that same as situation 2? Yes. Let's still read. It says the company P takes a loan from Q. The loan is perpetual and entitles the holder to a fixed rate of 8% per annum. Examine the nature of the instrument. Now, I want to spend some good time on this. Now, what I'm about to discuss could be a little disturbing, but you're going to get a couple of answers at this stage. So the next 5-7 minutes is going to be crucial. Please watch me carefully. I am wanting to discuss this illustration number 26, the pending illustration number 6 earlier, 3 earlier. So this is illustration number 26. And this is the same illustration number 3, which I have kept it pending for quite some time. This is in the unit number 3. And this is illustration 3 of unit 1, which is being carried forward. Please watch me carefully. Please hear me carefully. I'm now giving you a little input on my agenda 2. I am in between going to the agenda number 2. As I said, my first agenda is only to, decide, is it a CFI? And the agenda number 2 is to do the split accounting of the CFI. I'm going slightly to the agenda 2. Now, I am just, slightly diverting my discussions and going to the agenda number 2, where I want to explain the concept of what is called a split accounting. What is called a split accounting, which is applicable to a CFI. I'd just like to, take you back to school, and let's understand one thing very clear. I remember, when all of us were in school, we were taught a double entry bookkeeping in life. And when we were given the concept of a double entry bookkeeping, so we said a company took a loan of 10 lakhs. So what is the journal entry? We said bank gets a debit, loan gets a credit, 10 lakh, debits, credits becomes equal. We didn't realize at that point of time, nor anybody told us as well, that liability is not what you receive. Liability is what you're going to pay. So if I take a loan of 10 lakh rupees, this is the amount I've received today. That's not my liability. My liability is what I'm going to pay. I am going to pay the interest. I am going to pay the principal, but all this is going to be paid at a future point of time. So when I borrow the money, when I take a loan from someone, we can say the money is received. Let's call it as proceeds. Let's call it as proceeds. But that's not the amount of liability. The liability is that when I take that loan from someone, let's say the period of the loan is 5 years, so I am going to make a payment of interest for the next 5 years. I am going to pay the principal at the end of 5 years. So my liability is supposed to be those future payments. And if I want to express my liability today, what I need to do, I need to apply a time value of money and consider the present value of all those future payments today. So remember, my liability is not the amount I receive. The liability is the amount which I'm going to pay in the future in the form of interest, in the form of principal, which is going to be discounted at time value of money. I hope you're hearing every word carefully. I know you are, but I'm still, just telling you that please hear this carefully. So which means that when I do a split accounting, when I'm going to do a split accounting, I need to consider the proceeds collected. So let's say, for example, if you took a loan of 10 lakhs, this is just an assumption. This is just an assumption. This is not a part of the illustration number 26. It's just an assumption that let's say if you take a proceeds of 10 lakh rupee and I want to segregate, that out of this proceeds, what is my financial liability? I would say my financial liability is supposed to be the present value of future payments. It is the present value of the future payments because my liability is what I'm going to pay at a future date, and this is going to be discounted at time value of money. So in this case, when I say the future payments, it is going to be the interest and the principal both, which is going to be paid at a future date. Now, the only question which comes to the mind is that when you say that you are going to consider the present value, you need a discounting rate. So what is the rate at which a discounting is done? Now, hear this carefully. Remember the story of those three people, Mr. ABC, which I gave you in the last class, where I said that A was being given interest rate, let's say at 12% or 10%, what I gave you. And Mr. C was being told that we'll give you interest rate lesser than Mr. A. We told Mr. C that I will not give you the same interest which I give to Mr. A because he doesn't get the option to convert, but you get the option to convert. So I told him that technically speaking, I would have given you a 12% without conversion, but you want a conversion option, so be prepared to take less than that. So which means what is the rate I would have ideally given in terms of the pure financial liability? Please hear the words carefully. So what is the coupon rate I would have given, if it is a case of a financial liability? You're identifying the financial liability element. So in this case, the coupon rate I would have given is the interest rate on a non-convertible instrument. So the standard very clearly says that when you go to consider the present value, you are going to consider something which I call as a benchmark rate. Something which I call it as a benchmark rate. And this is the interest rate on non-convertible financial instrument. It's on a non-convertible financial instrument. Let me put this once again. So the standard was very clear on the thoughts that if you're making somebody agree on a deal, when you're making somebody agree on a deal, you'll say, okay, I'll give you interest lesser than the non-convertible instrument, because when you're giving the option to convert. So in that particular case, you're saying, ideally, I would have paid a 12% coupon rate, but you take the option, so I give you a lesser rate. So my financial liability in this particular case is going to be measured. My financial liability is going to be measured at the benchmark rate for the financial liability, which is the coupon rate on a non-convertible instrument. So when you go to calculate the present value of future payments, you go to consider a benchmark rate, interest rate on a non-convertible. Now let's apply some basic finance. Let's apply some basic time value of money concept. You all know the basic concepts well. If I pay interest at 9%, but I discount it at 12%. Please mind it carefully. Let's say I borrow 100. Let's say I borrow 100. Now on this 100, I pay interest at 9%, but I discount it at 12. So let's say if I take 100 rupees from someone and I pay a 9% interest, I'm going to pay 109 at the end of first year. But if you discount it at 12%, are you going to get 100? Are you going to get less than 100? Think of this mathematically. So I took a loan of 100 rupees from someone. I said, okay, I give you a 9% interest. So at the end of first year, I'll give you 109. But if I discount it at 12%, if you discount 109 at 12%, are you going to get 100 or are you going to get less than 100? Think. Just apply the basic maths and let's see what is the results. Time value money is what we are applying. So in this particular case, I get the answer very correct. We are going to get a lesser answer in this particular case. That's absolutely makes sense to me. That's absolutely correct. We are going to get an answer which is going to be less than 100% sure. So which means, imagine if this is the proceed 10 lakhs and you discount this money, you will get a figure less than 10 lakhs for sure. And if you're going to get a figure less than 10 lakhs, I am going to take a balancing figure, and that balancing figure represents the equity component of the instrument. So when you segregate the proceeds of 10 lakhs into the financial liability, you're going to get a balancing figure which is equity. So my entry is bank debit with the proceeds, a financial liability credit with the present value of future payments, and you get equity as a balancing figure. Wow. We never learned this in school because we were given the entry basic accounting understanding, bank debit, loan credit with the proceed, bank debit with the proceed, loan credit with the proceed. But we need to understand, liabilities is not what you receive today. Liability is what you're going to pay at a future date. So if somebody, just look at this at a very simple understanding of the deal. If somebody tells you that, I would have paid you 12%, but he lures you into the deal by paying you a 9%, which means he is not paying you the 3%. If he's not paying you the 3%, then the 3% technically is what? Equity. Because when you go to calculate the present value, you're going to take the benchmark rate 12% to discount. So you're definitely going to get a balancing figure. I hope you got some basic art of split accounting, though it is agenda 2, but I just wanted to give you to discuss illustration 26. I have not yet discussed 26. I am yet to discuss this illustration. I've just made some background music right now, and we'll come back to now illustration 26, illustration 3. But I hope you got the dots connected. That in terms of a CFI, since you would have suppressed your obligation towards the holder, so you're paying interest at a lesser rate as compared to a benchmark rate. So your financial liabilities will never equal the proceeds, and the difference in the proceeds and the financial liability is going to be called as an equity component. Right? I hope I get connected. Let's go ahead now. Now, there is a very interesting discussion which is done in the appendix to Index 32. You would say suddenly this man comes out and the blue and stocking in terms of the text of the standard. Yes, there is a very interesting discussion which is done in the appendix of Index 32 and in the appendix of Index 32. And when you look at the beautiful discussion which is given in the appendix of Index 32, and in this appendix, that is appendix B, I guess, there is a beautiful discussion which is done on a perpetual debt. There is a beautiful discussion which is done on a perpetual debt. Now, if this is a perpetual debt, in this particular case, let me remind you, I'll connect the dots later as well. This discussion was based on somewhere that this is a optionally convertible instrument, where the coupon rate given is lesser than the non-convertible instrument. So some way or the other, My example on this discussion is on a convertible, optionally convertible instrument. Now, the discussion which is given in the appendix to Index 32 on a perpetual debt is very interesting. They say that the perpetual debt, let's discuss this in two parts. The interest rate on, let's say, a perpetual debt is 10%, and it says the market rate is also 10%. And the second case they've discussed is the interest rate is, let's say, 8%, and let's say the market rate on a perpetual debt is supposed to be 10%. You can see the cases carefully. In the first case, they've taken a presumption that the interest rate is 8, interest rate is 10%, and the market rate is also 10. You're paying what you ought to pay, considering it's a perpetual debt, and in this case, the interest rate is 8 and the market rate is 10%. Let's take a figure. Let's say that the perpetual debt, when it was issued, let's say when the perpetual debt is issued, let's say the proceeds are to the extent of 1,000, just assumed. Now watch this carefully. Ideally speaking, so far, you will get the essence. Perpetual debt means irredeemable principal, equity, and the interest is paid is liability, equity, liability, CFI. That's what will reach a conclusion without the facts. I would say that, there is an irredeemable loan that makes it equity, and there is interest that's a liability. So anybody would say that, yes, it is a compound financial instrument. But, now let's make a walkthrough. Now let's apply the inputs which I gave you so far on the calculation of the financial liability. So let me calculate my financial liability in the first case. I am going to pay interest at the rate of 10%. So on 1,000 rupees, I'm going to pay a 10% interest, that is 100. And this 100 is going to be paid forever. This 100 is going to be paid forever because it is perpetual. So you are going to pay 100 rupees forever. Would you like to tell me what is the present value of this annuity till perpetuity? I think just apply your financial management concept that if you're saying that you're going to pay this annuity, you're going to pay this annuity forever. So this 100 is the annuity which is going to be paid forever. So how do you calculate the present value of annuity till perpetuity? I'll tell you, when you calculate the present value of this annuity till perpetuity, so when you calculate the present value of this annuity till perpetuity, you apply A by R. You apply the concept of A by R. And when you apply the concept of A by R, so you can say 100 is going to be divided by this 100. I'm going to divide this 100 by the market rate of interest, not on the coupon rate. I'm going to divide it by the market rate of interest which prevails on a perpetual debt. And when you take A by R, this works out at 1,000 itself. Now, please tell me, if the proceeds are 1,000 and the liability is 1,000, is there any equity element? No. If there is no equity element, then in this particular case, can it be a compound financial instrument? No. Which means in this particular case, when the interest rate and the market rate is same, trust me, this is not a case of CFI, but it is a case of a financial liability. It is a case of a financial liability. So now I'm getting confused, sir. I'm getting confused, sir. You're talking of one example optionally, then you're talking perpetual loan. I'm just a little confused. No worry. I will just connect the dots very carefully, but just see the maths. Your interest rate is paid at the rate of 10%, 100, and then you take the present value at the same rate. I think we know that much finance. That if you go to compound at 10 and then discount at 10, you will reach the same amount. So in which case there is no equity component in this instrument. The standard gives us an explanation which is beautiful, that why is it not a CFI? They say that, when you look at a perpetual debt which is paid at a market rate of interest, it is like, it is getting renewed every year. You're telling the issuer, no worries, you can renew the payment of principal year by year. And you should not take the irredeemable debt to be, in the essence, to be irredeemable. A perpetual debt you can consider, it's like, after the end of first year, you said, okay, no problem, renew the payment date. So the renewal date, the principal is getting renewed to be paid at the end of each year. So you're making a continuous streams of interest at market rate and renewing the principal, it's a pure financial liability. But if I look at now this example, I would say, okay, if I want to calculate a financial liability, then I would say that on 1,000, we are paying an 8% interest, and that 8% interest is supposed to be 80. Because now in this particular case, the interest is paid at the rate of interest 8%, that is 80. Now when you calculate the present value, of this perpetuity, this annuity, you'll take 80 by the rate of interest. And we're taking the market rate of interest, which is 10%. So now you can see that you are paying interest at 8%, but discounting it at 10%. So in this case, it becomes 800. Now in this case, you can see the proceeds will never match. Since the proceeds will not match, the balancing figure is equity, that is 200, and therefore it becomes a compound financial instrument. So you please connect all the dots once again all together in terms of what you've discussed in the last 5-7 minutes. Okay, I understand that. But before I consolidate my discussions, let me make one thing clear. Never ever consider a perpetual debt to be a CFI outrightly. No. In case of a perpetual debt, you need to see that what is the interest rate and what is the market rate. If the interest rate and market rate is same, it's a financial liability. If the interest rate is less than the market rate of interest, it is a compound financial instrument. Because in this particular case, the interest rate is commensurate to the risk profile of the issuer. Aha! Remember the sentence, everywhere it is given that the interest rate is commensurate to the risk profile of the issuer. I am paying what I am supposed to pay. If I pay what I'm supposed to pay, it's a liability. If I don't pay what I'm supposed to pay, it creates an equity element in my instrument. Did you get the point? So when I pay the interest rate, which I am supposed to pay, then where is the equity element? There is no equity element. But if I pay what I'm paying less than what I'm supposed to pay, then it gives rise to equity element. The concept of equity element is, not paying the holder what you're supposed to pay. You take the deal, lower him for any reasons. I'll give you 8% instead of 10. I'll give you the option to convert. So you are indirectly suppressing your own obligations and telling the other person that it'll pay you less. So please connect all the dots together. Okay, let's go ahead. Let's come back on the agenda and let's take a rewind in terms of things. Now you're going to get all the dots connected in the next 5-10 minutes. So we are discussing the agenda number 1, sir. But let's tell you one thing, sir. Every class, the level of CFI is increasing. If you're feeling that, it's a very correct feeling. Is the level going to increase in the coming classes as well? Wow, you thought it correct. But what is important is you should understand what we are discussing in this case. The level is increasing, but it's a technical standard. But I think if you get the essence very clear, trust me, you can easily crack questions in the exams on this standard. Let's now connect the dots. Let me also see if there's any questions coming in between so far. Okay, now everything is jumbled, sir. Wonderful. That's what I wanted to hear. So nobody's on that. Now, just Amy, and let's connect all the dots. Now, you need to hear me very well in the next 5-10 minutes to get all the dots connected. We are talking of a compound financial instrument. Now, you need to understand my focus right now. My focus right now is on two kinds of compound financial instruments. I'm going to look at this one. I'm going to look at this one. Sorry. So I'm going to look at this one and I'm going to look at this one. Now, when I'm looking at this one, assumption, I'm assuming that the derivative is got equity characteristics. Please hear my words carefully. When I'm going to look at this, I'm going to consider the derivative is got equity characteristics. So I will not segregate the derivative. So I'm looking at optionally convertible instrument. Now let me say something point blank. Let me get your answer. In this case, if I assume that the derivative has got equity characteristics, can I say I will not segregate the derivative and it is a CFI? Agreed? Please give me answers on that. So if I say that the derivative has got equity characteristics and I'm saying it is optionally convertible, undoubtedly it is a CFI. So why? Because you will never pay the interest on an optionally convertible instrument equal to what you would have paid on a non-convertible instrument. Agreed 100%? I think let me see if we are standing on the same page in this case. So are we standing at the same page? And yes, we get the answer. Yes, wonderfully agreed. Good. So now we are looking at this instrument, which is derivative is not segregated, 100% CFI. Now let's come to this one. Our learning so far on the second situation is it is a CFI, basic understanding. Because we've seen that the interest is paid on a mandatory basis. FL, the principal is irredeemable. It's equity, it is CFI. Now I'm breaking that myth. So please hear the next couple of minutes very carefully on what I'm saying. This is undoubtedly a CFI. But this is what we've been thinking so far is a CFI, but it's a myth. And I'm, consolidating and clearing myths as we proceed. Now, first we'll talk about this, then we'll talk about this. So let's first talk about this option number one. And I was discussing this case. This is the case of optionally convertible instrument. This is not discussion on illustration 26 or 3. This is not. I am discussing this. I'm taking you progressively, but this discussion is not on this illustration. It is taking a focus optionally convertible instrument. So I thought let's first give you a feel of how the equity and the FL is segregated. I said, let me just walk out of my agenda number one and take you to the agenda number two. And in advance, I started explaining the concept of split accounting. Considering optionally convertible instrument as a base. So I said that this, let's say the proceed of the instrument is 10 lakh, we need to segregate the liability equity. I said, so, okay, what is a liability? Let's go back to school. So we said a liability is what? Is the liability the amount I received today? No. Is the liability the present value of the future payments I'm going to make? Yes. So when I take money from someone, I will be paying them interest at a future. I'm going to pay the principal at a future. So what is my liability? The present value of all the payments in the future, because you need to express the liability as of today. So we decided that you would consider the present value of future payments, interest and principal. Then we applied some basic finance. And we said that when you go to consider the present value of the future payments, what is the rate at which you will discount to calculate the present value? You made the other person agree. Remember, we're talking of optionally convertible instrument. You made the other person agree that instead of giving you 12%, I'll give you 9. So he is willing to take on 100 rupees a 9% interest and take 109. But I will not discount my liabilities at 9%. I will discount my liabilities at the rate which prevails on a financial liability. You made him agree to take a lesser money, but I need to discount it at the rate applicable to a financial liability. And what is the rate applicable to financial liability? The benchmark rate, which is the interest rate on a non-convertible instrument. So when you took 100 rupees and you said, I'll give you 9%, I'll pay you 109, but when you discount that 109 at 12%, it will never come 100. So this will come less than 10 lakhs. So if your proceeds are 10 lakh, you're going to get a money less than 10 lakh and you get the balancing figure equity. Is this case clear? Optionally convertible instrument, is this 100% clear? That when you're calculating FL, you pay at 9, discount at 12, which is the rate applicable to FL, and you are able to get the liability, which will never match 10 lakhs, always be less, resulting in an equity component as a balancing figure. Did you get the results? Please say yes or no. Okay, I get a yes on that. I think we all need to be in a perfect agreement on our discussion so far. Okay, that's right. I got a yes on that. That's wonderful indeed. Now let's proceed further. This was optionally convertible instrument. Now I said, let me come back on the perpetual debt. Now we are back on the discussion of a perpetual debt. And I said, let me take you to the discussion. Let me take you to the discussion on the appendix of Index 32. Now you need to understand and appreciate. You need to understand and appreciate one thing. In case of an optionally convertible instrument, the benchmark rate is a rate on non-convertible instrument. But in terms of perpetual debt, where is the question of getting an interest on a non-convertible instrument? I'll consider a market rate. Is the interest being paid at market terms or not? At the end of the day, remember, when you say it is a CFI, you suppress your obligation. You tell the person, instead of paying you 12, I'll pay you 9. So how does the equity element arise? The equity element arises. The equity element arises in a situation where you do not pay what you're supposed to pay. So the appendix to Index 32, in terms of a perpetual debt, started giving me data. This is the interest rate and this is the market rate. Or let's say this is the interest rate and this is the market rate. They wanted to give us an idea that, you may be paying interest exactly what you ought to pay. Or you may be paying interest lesser than what you're supposed to pay. The presence of equity arises only when you pay less than what you ought to pay. The presence of equity cannot arise when you're paying exactly what you ought to pay. So they started taking an example, and I took an example to illustrate my point. I said, if it is a 10% interest rate, let's say that your proceeds 1,000. So you will pay a 10% interest, this 10% coupon rate agreed. So you will pay interest of 100 every year. So when you will pay interest at 10% every year, it becomes annuity till perpetuity because it is perpetual debt. So my only outflows in terms of obligation is that I'm going to pay 100 every year. It's annuity, common amount, paid till perpetuity. So when you divide this 100 by the rate of interest, you get the figure which is exactly 1,000. And that's bound to be. If you're paying interest at 10 and you discount it back at 10, your present value will be equal to 1,000. So there is no equity element. And why there is no equity element? Because you paid what you ought to pay. But when it came to the second situation where the interest rate is 8% and you ought to pay 10, you're suppressing your obligations. You're paying 80 rupees. Now, when you discount this annuity, which is 80, at a market rate of 10, you will get the answer 800. So out of 1,000, your liability is 800. The balancing figure is equity. Moral of the story. So when I say perpetual debt, you will ask me, sir, tell me the coupon rate of interest and the market rate of interest. If the coupon rate of interest and market rate of interest is same, so it's a financial liability. If the coupon rate is less than the market rate of interest, sir, it is a CFI. You will now never say, looking at a perpetual debt, that it is a CFI. That's very basic. Your second stage of learning is that if it is a perpetual debt, you need to put question. You need to say that, okay, give me the interest rate and give me the market rate, and then let's decide it's FL or is it a CFI. Did you get the dots connected on the illustration 3, illustration 26, on the concept of a perpetual debt, the pending story complete, and also the risk, the interest rate is commensurate to the risk profile of the issuer means what? I am paying what I am supposed to pay. Because if I don't pay what I'm supposed to pay, it gives rise to an equity element in the instrument. Tell me, friends, am I clear on my thoughts? Let's get the inputs. So tell me, are you now clear on the thoughts in this case? Very, very clear. That's wonderful indeed. Super. I get a yes quickly on that. I think yes, you need to, of course, make your revisions as well. But I've given you the thoughts in a very, very systematic manner, connecting you on the concept, what to look at, what to look at. And I think in this case, discussing the agenda 2 was a little necessary in advance. Wow. So let's come back on the inputs in this case. So I am coming back on the illustrations, which I was discussing with you. So I'm back on the illustration number 26, which is a perpetual loan. And trust me, if you look at the study material, I would say it's wow. I would say it's wow. I think on the financial instruments and even other chapters, the things have been organized for a conceptual understanding in a very systematic manner. Because I think they wanted to pen down all the kind of thoughts that when you look at the inputs given, you get a connected dots in terms of things. Very well written, I would say. So the Board of Studies done a wonderful job on that. Okay, now let's come back. So it says P takes a loan from Q and the loan is perpetual and entitles the holder to a fixed rate of 8%. Examine the nature of the instrument. Examine the nature of the instrument. So I would just like to come back. Let me just crop this up so that we can see the inputs clearly. So if I now look at the solution, see what is the inputs given. It says the instrument has got two components. One is mandatory interest by the issuer for a fixed amount at a future date and the perpetual nature of the principal. The first component is a contractual obligation to deliver cash, and that cannot be avoided, and it is a financial liability. The other component is supposed to be an equity because it is not required to pay the cash or another financial respect. Therefore, it is a CFI. Since in the question I was not given the rate of interest as per the market terms, so which means I was just given that the interest rate is 8%. It was given that the interest rate is 8%. Now, I would like you to have a look at that illustration, which is given in the appendix to Index 32. I'd love to show you that, and I'm going to show you that on the screen, and which is going to give you a wonderful idea on this particular part. So just give me a minute. I am interested in, taking it further and showing you something. Just have a look. I just take a minute and I am going to show you something wonderful in terms of the appendix. So I will not be able to share it on the board, but I'll share it on the screen so that you can have the idea of what is given in the appendix to Index 32. So that's a wonderful illustration, and I think I'll definitely like to show you that. I'm sharing that on the screen, and you can have a look at this. The para number AG6. AG is called the application guidance. AG is called the application guidance. Now, what I want you to do is look at this particular highlighted portion. Look at this highlighted portion. I'm just reading it to you. For example, an entity may issue a financial instrument requiring it to make annual payments in perpetuity equal to the stated rate of interest 8% applied to the stated par or the principal amount of 1,000. Exactly the same illustration. Now see what it says, assuming 8% is the market rate of interest when issued. It says 8% is assumed to be the market rate of interest when issued. The issuer assumes a contractual obligation to make a stream of future interest payments having a fair value that is present value 1,000 on initial recognition. The holder and the issuer have a financial asset and liability respectively. What is the proceeds of this instrument? The proceed of this instrument is supposed to be 1,000. And what is the financial liability of the component of this instrument? It is 1,000. And why so? The stated interest rate is 8 and the market rate of interest is 8. If the stated rate of interest and the market rate of interest is equal, it becomes a financial liability. But in this particular case, if I say the stated rate of interest is 8 and the market rate of interest is 10%, then it'll become a case of, you can say, a case of compound financial instrument. Did you get my inputs 100% clear? I hope I stand 100% clear on my agenda. Now, is there any confusion points, friends, at this stage? So one of the gist is we can draw in a consolidated financials. It's the difference between the benchmark rate and what we pay. You can say that, of course. The market rate of interest is the benchmark rate. And you can say, in this case, what you're paying is contracted. 100% clear on the agenda. Superb. So I think I've now given you the essence of my agenda number 1. And I'd like to show you something more at this stage. You know, if you just like to go back now, okay, let's come back to illustration 27 again. If you notice in the agenda number 1 in the study material, they took the first illustration, which was a non-derivative instrument. The second illustration on a perpetual loan. Now comes the embedded derivative. So now you're going to see the other one, embedded derivative. Look at the illustration 27. Optionally convertible, redeemable, preference shares, OCPS. And you know, the moment you hear the word optionally convertible, aha, CFI, derivative, and if the derivative got equity characteristics, not to be segregated. Let's now read. It says D issues preference shares to G. The holder has got the option to convert the preference shares to equity anytime up to a period of 10 years. If the option is not exercised, the preference shares are redeemed at the end of 10 years. So the issuer in any case has got an obligation to pay. Examine the nature of the instrument. Now let's, I think, go with the input C, what is written in the answer. It says now, and so optionally, we need to check the fix for a fixed test. Yes, for the derivative element. For the derivative element, we need to test that. So I think let's read the second part first of all. Or let's read it together. The instrument has got 2 components. It says, and this was the same illustration number 5 of unit number 1. The contractual obligation is conditional on the holder exercising the right to redeem and the conversion option. The conversion option is the derivative. The first component is a financial liability because the entity does not have unconditional right to avoid paying cash. So in this case, the payment of, you can say, the interest, though we are not given any details regarding the interest rates. So we can definitely say that the first element of making a payment of interest and the principal is financial liability. But When you go to calculate the financial liability, the coupon rate at which you're paying the interest will be lesser as compared to the non-convertible instrument. So will that make it a CFI? Tell me. So when you are going to calculate for the first component, when you go to calculate for the first component, the FL, can I say the interest rate paid is going to be lesser as compared to the interest on a non-convertible instrument, leading to a CFI, right? That's correct. That since the lesser rate of interest will be paid. So right now it says FL, but it'll become a CFI because of the interest rate lesser as compared to the benchmark rate. Then he says the other component conversion option is an equity feature if they've taken a presumption that the conversion option, the derivative, is an equity feature if the fixed for a fixed test is met. That's an assumption. If the conversion option does not fulfill the test because the conversion ratio varies, it is a derivative liability. And this is called a hybrid instrument. So as I said earlier as well in the previous class, that optionally convertible instrument where the derivative is equity, you're going to see FL and equity, two elements. If you say optionally convertible instrument, the derivative is FL, there will be three components, FL equity, that's on the CFI, and there will be a derivative FL as well, three elements. Wow, my agenda number one gets over, friends, on that. My agenda number one gets over on that. Now let me, I think, just connect the dots with you carefully so that once you revise, you get the dots very clear. If you look at my agenda number one in terms of identifying whether an instrument is a CFI or not, see the thought process of the study material. They gave you the first illustration, which is a non-derivative where one element is FL, another is equity. That's like non-derivative situation one. Then they give you the second case, which is again non-derivative, a perpetual loan. And that perpetual loan depends upon the fact whether it is supposed to be, market rate equal to the market rate equal to the coupon rate or not. That decides. So second illustration. And then they went to the third one, that was a case of hybrid instrument. So you can see I gave you three situations. They've given you the same three illustrations. Non-derivative, where one element is equity, another FL. Then there is perpetual loan, which can be CFI, can be financial liability, depending upon the market rate and the contract rate. And the third one is the hybrid instrument, which is undoubtedly CFI. Undoubtedly CFI to me. And in this particular case, whether the derivative is segregated or not depends. I think we finished our agenda number one. We've already started agenda number two. Now we're going to do our, deep understanding PhD in terms of the CFI as well. Looking into various categories of instruments now. We're going to look at how the accounting for a CFI is done. If it is supposed to be a perpetual loan, which perpetual debt, which is a CFI, or if it is optionally convertible, or if it is partially convertible, or if it is, let's say, mandatorily convertible, but it is going to be converted in fixed number of shares. So we've got 3-4 types of questions to do. Because when you look at agenda number two, we need to be clear on 4 kinds of CFIs, how the accounting is done A to Z. Perpetual debt, when the market rate is less as compared to, the coupon rate is less compared to market rate. It could be optionally convertible instruments. It could be partially convertible instruments. Or it could be mandatorily convertible instruments, which will be converted to fixtures in the end. So we're going to work upon these 4 agendas now. Let's proceed further. I'm sure you must be getting now clarity of thoughts as well. I know the levels are increasing. But I am trying my best in terms of giving you things to decide in a very, very, very chronological order of thoughts. And as you keep doing the cumulative revisions, many things which we discussed initially, the dots will get connected later. Because, since it's a chapter, it's a standard which is interlinked to every core. So you're going to see a few things said maybe in the class second gets really connected today in class 3. So once you do the cumulative revisions, you're going to get things, absolutely connected well. Let's go to the next agenda now. And our next agenda is looking at now the solving of the illustrations, that is the split accounting. So I'm now going to share the examples on this as well. So we're going to see the illustrations as is given in the study mat to have a look very carefully. And I'll show you something, which is interesting to watch. Just for see the thought process, how things are built in the study material, and you'll love it. You'll love it. We'll zoom it later, maybe the need arises. Right now, the idea is just to show you a few things, so that we can start working on the agenda number 2. Now see how the agenda number 2 is being covered. How the agenda number 2 is getting covered in the study material. And you'll also see in terms of the third agenda also. Now just see the data. We are now on the agenda number 2. How to segregate the liability equity elements of CFI. Now just watch this carefully. Look at the illustration number 28. It's a perpetual loan with a mandatory interest. Now watch the data. What is the interest rate? 8%. The rate of interest commensurate with the credit risk profile is 12%. I think somebody asked me that question long time back. So what do you mean by this interest rate commensurate? Now you got the answer. Now let me ask you, the rate of interest is 8% on the loan and the market rate is 12% considering your credit risk profile. Is it undoubtedly CFI? The interest rate is 8 and the market rate is 12 according to the credit risk profile. Is this a CFI? Yes or no? Now you know this very carefully that yes, it will be. Wonderful indeed. That's absolutely correct. We got the correct answers in that. Okay, we get another question. Sir, if an optionally convertible instrument is with equity, then it is not hybrid instrument, and hybrid instrument is only when optionally convertible instrument is with, you mean to say, derivative financial liability. I agree to that extent, but we'll still call it as hybrid. I'll tell you why. It is hybrid because there is a derivative embedded. Now, whether you segregate the derivative or not is the criteria whether it has got equity or a financial liability characteristic. You got my point. That when you say that the instrument is supposed to be a derivative, so when you say the instrument is supposed to be derivative, so we are saying there is an embedded derivative. Now, whether the derivative has got equity characteristics, you don't segregate. If it has got liability characteristics, you segregate. But that's, the treatment thereafter. But I think it is still hybrid. It is the agenda of segregating the derivative or not is the issue. But that does not change the nature. The derivative is not embedded. It is embedded, but we're taking a decision whether to segregate it or not. Got the point, I guess? Clear. Wonderful indeed. Okay, so let's, I think, come back on the first case. So this is my first case. It says P issues and takes a loan at 12 lakhs. The proceeds are 12 lakh. The loan is perpetual and the holder takes a fixed interest 8%. Now, you've got a choice, friends, which I know you're not going to refuse in any case. I am thinking to give you more clarity of thoughts, making leisure accounts of these particular questions, and also giving you a presentation in terms of balance sheet, and also giving you a presentation in terms of SOKI. So you want to look at the extract balance sheets, extract SOKIs with the leisure accounts. In all these cases, you can say a no, I accept your things. But I know you're going to not say no. You're going to say a yes. That also in the capital YES. So take your call and decide. You want me to give you the accounting in a little more detailed fashion to see how this instrument looks in the presentation of the balance sheet, along with the statement of changes in equity and the movements in the leisure accounts in terms of things. I think I start getting an answer that is also in the capital yes. The answer comes yes, 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 yes. I love it. I love it indeed. Wonderful. So let's do one thing. Let's, I think, go to the illustration number 28. So I am going to solve this illustration number 28. Let me solve it here. So we're going to solve the illustration number 28, but before I solve the illustration 28, now what we need to get a clarity is the presentation under Index 32. I never gave you the presentation and it is 32 before we solve. Let's give you a look now. Imagine this is my extract balance sheet. Imagine this is my extract balance sheet. So I am making this balance sheet extract. I am making the extract balance sheet and I'm also making a SOKI. So I don't know, friends, whether you know much details on SOKI or not. I don't know. Do you know that SOKI has got a total of 3 tabs? I don't know if you've learned it that way or not, but are you aware that SOKI has got a total of 3 tab systems practically? I don't know if you've been told this or not, because everybody looks at SOKI in a very different manner. But I definitely look at SOKI in a different manner. SOKI not done yet. Okay, not a problem. 3 tabs. Okay. So I get another input. So once we can draw that in. Okay, I think that was done. Okay, so in detail, that is yes. Okay, so no worry. I think I'll give you that input as well. So this is the statement of changes in equity, and it has got 3 tabs practically. Some people call this as tabs. Some people don't call this as tabs. But this is, how we practically look at things in practical world. So we've got 3 tabs out here. Now let me tell you what are the 3 tabs of SOKI. The tab number 2 is the reserve and surplus. And the tab number 3 is the OCI component. The tab number 3 is on the OCI component. We will take a call, once we come to the concept of OCI as well, that how comfortable you are. Otherwise, I'll give you a briefing maybe on the concept of other comprehensive income if the need arises. But whatever enters in the profit and loss section of the income statement, whatever enters in the profit and loss section of the income statement that goes in tab 2 under reserve and surplus, retained earnings, and whatever is taken in the OCI section of the income statement, that is what goes in tab 3. Now, what is tab 1? I'm just going to, give you tell you the suspense in this case. So let's say this is the equity and the liability side. And let's say this is the amount. Now I'm just taking a basic structure in terms of the equity. So you've got equity, and this is equity share capital, and there is other equity. And when you consider this other equity, this is the other equity which is elaborated by SOKI. Because whatever is the other equity in the financials, the breakup of that other equity is available in the statement of changes in equity. And then we can consider the non-current liabilities, in which we consider, first of all, financial liabilities, and we consider borrowings. This is how the extract of the balance sheet, Schedule 3, Division 2 looks like, that you've got equity and you've got liabilities, and that's borrowings. Now, please hear me very, very carefully. Please hear me very, very carefully. A company issued, let's say, equity. Let's not talk of hybrid. A company issued, let's say, equity instrument, 1, or a financial liability, 2, or a compound financial instrument, 3. Now, if you issue an equity instrument, let's say equity shares, you would present it in equity share capital. If you issue a financial liability, an instrument called a financial liability, it's going to be a part of the borrowings out here. But if you issue a compound financial instrument, the liability element, the financial liability element enters here, and the equity element enters in other equity. The equity component, after you've done the split accounting, the financial liability element goes in borrowings and the equity element is in other equity. And this is what is called the equity component of CFI. That's tab 1. This is called equity component of compound financial instrument. I hope you got the picture very clear. So this is how we're looking at the presentation of the instrument. This is how we're looking at the presentation of the instrument, that when you issue an equity instrument, it appears in the balance sheet as equity share capital. When you issue a financial liability, it appears in the balance sheet as a financial liability itself. But in terms of the compound financial instruments, you need to do the split accounting, and the financial liability enters in the FL, the equity enters in the other equity, and that is called the tab 1, equity component of CFI. So whenever a company would issue a compound financial instruments, you can go to the SOKI and watch out. You can see the SOKI and watch out that in the tab number 1, there is going to be equity component of compound financial instruments. I hope the presentation is clear. I want you to first look at the presentation, because we are talking in this 32 presentation in the balance sheet from the issuer perspective. Let's now proceed further with this input now. So this is not illustration 28. This is just a presentation. This is just to give you the presentation, how things will appear in the balance sheet of a company. Okay, now let's come back to the illustration 28, just to give you the facts once again. So we're looking at the illustration number 28, where this says the company issued a loan for 12 lakh. It is perpetual, and the interest rate is 8, and the market rate is 12%. So now let's proceed with the illustration number 28. So we are now working on the illustration 28, and let me tell you what we are working upon is, I would call it as case 1, and I'll call it as a perpetual loan. I'll call it as a perpetual loan so that you'll easily recall the data, and I'll also put down that the interest rate is lesser as compared to the market rate. The interest rate is lesser as compared to the market rate. So this will immediately remind you, okay, this is a CFI. This will immediately recall the data that this is supposed to be a compound financial instrument. Why is it a compound financial instrument? When you look at this data, you get connected. So let's do one thing now. Let's first take the proceeds. Let's first take the proceeds in this case. So what is the proceeds in this case? The company issued a loan for 12 lakhs, so we can say the proceeds is supposed to be 12 lakhs. So we need to segregate what is the financial liability and what is the equity component. So we'll take the financial liability and we'll take the equity component as a balancing figure. So when you consider the financial liability element, what is the interest we are paying? We are paying interest at 12% forever. So what is 8% on 12 lakhs? That works out at 96,000. So we are going to pay an annuity of 96,000, and this is going to be divided by the market rate, that is 12%. So just to give you the calculations, this 96,000 is on that 12 lakh rupees, there is a 8% interest. So this is the annuity paid forever, discounted at the benchmark rate. And if you divide this by 12%, I think it comes to 8 lakhs. So we can comfortably get the balancing figure, and that is supposed to be 4 lakhs is the equity element. So where are you going to take this equity component? So can I say this is going to appear, can I say, in the statement of changes in equity, and this is going to appear in the tab number 1. This is going to appear in the tab number 1. So when I'm going to show the balance sheet, my financial liability is 8 lakhs, my other equity is 4 lakhs. That 4 lakhs in the other equity is in the tab number 1. Now let's see how the ledger account is going to be made. So let's have a look at the ledger account. So we'll just have a look at the ledger account. So this is my financial liability ledger. So we're going to first put the entry. So let's also give you the entry at the very start. So we can say the entry at the very start is going to be bank gets a debit. That is 12 lakhs. The financial liability component gets a credit, that is 8 lakh. And the equity component gets a credit, and that is 4 lakhs. So this is the entry which is done at the initial recognition. The bank gets a debit at 12, the financial liability gets a credit at 8, and the equity component gets a credit of 4. So the financial liability gets recorded at 8 lakhs. Now, you need to understand there is one very important golden rule, I would say, in terms of Ind AS. And I said there is one very important golden rule in the entire Ind AS if you see. You notice everywhere that if you consider the present value, so in the future, what we're going to do, compounding. So when you do present value discounting, and then it leads to compounding. And that compounding is what we call unwinding of discount. Trust me, whether you look at, for example, Ind AS 16, remember the provision for DROL, you took the present value discounting, and then what happened? You did compounding. So in those particular cases, you'll notice everywhere in the entire Ind AS, in any standard, if you do a discounting, it'll always lead to compounding, which is called unwinding. So what is this 8 lakh? It is a discounting at the rate of 12%. So what do you need to do? You need to consider the finance charge. So now you need to basically compound. So on this 8 lakh, you take a 12%, and that works out at 96,000. This is 8 lakhs into 12%. The rate at which discounting occurred, we're doing a compounding at this rate. And then at the end of the year, you pay this money. What do you pay? What do you pay is not this. You are going to pay on the 12 lakhs interest at the rate of 8%, that is 96. By chance, both are same. By chance, both are same. So in this case, it becomes 96, and they will definitely match in this case. You're paying 96, you're accruing 96, that is on the financial liability element. But what you're paying is on the proceed, the agreed rate of interest. And let me also tell you, what will enter the P&L? This will enter the P&L. This will enter the P&L, not this. So, but they are same, maybe. But ideally, if you ask me what goes in the profit and loss of the company is this, what you are supposed to pay on the financial liability, not what you're paying on the proceeds. The P&L will not take care of this figure, what you're paying. The P&L will take care of this figure, what you are supposed to pay on the financial liability element. And then you take the balance CD as a balancing figure, and the balance CD is 8 lakhs. And trust me, if you would make the ledger accounts for the coming years as well, they will be prepared absolutely on the same lines. It is going to be prepared absolutely on the same lines because the figures will not even change. The next year, this will become the balance BD. You'll take the same interest accrual. You'll make the same payment year by year by year. The ledger will keep moving, keep moving. The equity component of 4 lakh remains in the other equity because it's perpetual. So it'll remain in the tab number 1. And the balance sheet will continuously show you 8 lakh rupees in the balance sheet. This is the accounting for this case. Let's come back and let's see the detailed answer which is given in the study as well. Though I've just converted that all in ledger accounts for a better understanding of the picture. It says the value of the liability and the equity components are calculated as under. We take the present value of interest. So 96,000 is the annuity discounted at 12%. So we get the equity component is 4 lakh. In subsequent years, the profit and loss is charged with the interest of 12% on the debt. As I said, the interest is going to be on that 8 lakhs at the rate of 12%. The interest in the P&L is not 12 lakhs into 8. The interest is not 12 lakhs into 8. This is the interest which will be charged in the P&L. You'll get more clarity of thoughts regarding this when we come to India's 109, when we'll study in detail the concept of what is called EIR, that is called effective interest rate as well. Are we clear with the first case, friends, on this? Any questions coming to your mind so far on this agenda? Are we pretty clear, I guess? Right, so we get the data. Yes, I think the answer's done. Okay, wonderful indeed. This was illustration 28. Now I think let's go to the next one. So this is a case of a perpetual loan. Now we need to see the accounting in terms of that embedded derivative, which is optionally convertible in nature. Now see the setup. Illustration number 29, you can see convertible, optionally convertible instruments. Same illustration continued. Then you can see optionally convertible preference share with the issuer's redemption option. And then there is instrument convertible at the option of the issuer. So let me also tell you another interesting agenda as well. The options to convert may not necessarily be with the holder. When you're looking at an instrument, the option to convert may be with the holder, the option to convert may be with the issuer. So it's not necessary that every time the instrument, the option to convert is with the holder. Right now, we're working on the option to convert is with the holder. We'll see the option to convert with the issuer later. Let's, I think, go ahead. So let's come to the illustration number 29. Optionally convertible redeemable preference shares. It says on July X1, D issues preference shares to G for a consideration of 10 lakhs. The holder has got the option to convert. That makes it a presence of a derivative. It says to a fixed number of equity instruments for any time up to 3 years. If the option is not exercised, the preference shares are redeemed at the end of 3 years. The preference shares carry a coupon rate of 6%, and the prevailing interest rate without the conversion is 9%. Can I call this as a hybrid instrument? Because the coupon rate is 6 and the market rate, the benchmark rate is 9. So CFI with the derivative, and if the derivative meets the fix for a fixed test, then I will segregate the two elements only. Oh, yes. Now, it needs to be seen how the accounting of this instrument will take place, because this instrument has got a total tenure of 3 years. I'm sure you would also like me to tell you. So ultimately, the money which goes in the tab number 1, what do you do with that? Does it remain in the tab number 1 forever? Is that money taken somewhere or not? All this, what we're going to answer with the help of this illustration, but I think after the break, where I'm going to give you insights in terms of making a ledger accounts, the SOKI presentations, telling you the treatment of the equity component at the end as well. And for this particular purpose, I think I have another illustration also, which I can show you to give you more clarity of thoughts. But I think after the break. So please relax your minds in the break, friends. And because we're going to do some more interesting inputs. I get a question. Sir, fixed for a fixed test, in this case, number of shares fixed, but the consideration is not fixed. Well, I am not given in this particular case that the consideration is not fixed. Now, if you look at the data, the consideration is already been received right now. It's not that the consideration is yet to be collected. So you can say the consideration is 10 fixed, and against which you're going to issue fixed number of shares. So if you technically ask me, the consideration and the number both are fixed. So the derivative is supposed to be an equity feature, which is not going to be segregated. Correct? I hope you get your answer on that. So the consideration is fixed, and the number to be issued against that also becomes fixed in nature. Great. So I think let's give you some break, friends, 10, 12 minutes at the max. I'm going to see you after the break to enjoy this beautiful question. Please enjoy your break. Thank you. I hope you had a relaxation of mind. So we are now going to go back to the illustration, what we were discussing, how the treatment of an optionally convertible instrument is done. Though I'm taking you to a little different example, which I've just picked up, and I'm just going to share that on the board. And that's going to give you a good insight in terms of, because in this example, which I have chosen, you're going to see some more details in terms of looking at the conversion ratios, everything. So they'll give you a broader outlook. So I hope this is clearly visible to you. Okay, so I think let's begin. So I'm just going to read the facts of the case and then we'll solve this out. It says on January X1, Daniel issued a $50 million 3-year convertible bonds at par. There is no issue cost. We'll see later the treatment of issue cost in terms of CFI. That's another agenda. The coupon rate is 10% payable annually in arrears. Arrears means at the end of each year. And the bond is redeemable at par on January X4. It says the bondholders may offer conversion in the form of shares. The terms of conversion are we give them two 25-cent equity shares for every $1 of the loan owed. So is this a fixed ratio? When it says that we'll give them two equity shares for every $1 of bond, is that makes it fixed? That for every $1, you're going to give them two shares? Yes, I would say it is undoubtedly fixed. Then he says bond issued by similar entity without any conversion rights bear interest at the rate of 15%. So you can very clearly see that it's an optionally convertible instrument because the bondholders may offer conversion, giving them an option to convert. So the coupon rate is 10 and the market rate without conversion is 15. And assume that all the bondholders opted for conversion in terms of shares. We required how would the convertible bonds be accounted by Daniels. Okay, so I think this is very clear that this is a case of optionally convertible instrument where the option is with the holder and we can see that it is a fixed consideration and there is a fixed number of shares which are being given against this. So the equity element, you can say the option is going to be something which is going to get equity characteristic. So I think in this case, we are not segregating the derivative element having an equity characteristic. So let me just make the answer. So in this particular case, we can undoubtedly say that derivative, which is supposed to be the option, is got equity characteristics. It has got equity characteristics. And since it has got equity characteristics, therefore we can say there is no need to segregate. There is no need to segregate derivative embedded in the instrument. There is no need to segregate the derivative embedded in the financial instrument. Right, so I think this is one input I've given so that once you revise later, you get connected that why the derivative was not segregated because it has got equity characteristics and therefore not segregated. Now, let's begin our inputs on the split accounting. Let's begin the data in terms of split accounting. So let's see what is the proceeds. I am given the company issued that is for 50 million. 50 million would mean how much in terms of lakhs? I guess 500 lakhs, I guess. So we've got the proceeds. I'm just taking this in lakhs for convenience. So 50 million would mean a total of 500 lakhs. Okay, then we can segregate the liability and the equity element, or let's do it here. So let's segregate the financial liability and the equity component. So when we're going to segregate the financial liability, we'll consider the interest paid, unavoidable obligation to pay interest and the principal for the next 3 years. So on this 500 lakhs, we're going to pay interest at the coupon rate of 10%, but discounting will be done at 15%. So the interest will be paid at 10%. Let's get the present value factor, 15%, 3 years. So discounting will be at the benchmark rate. So whatever interest is paid for the next 3 years, discount this at 15%, 3 years. So if you take a factor at 15%, I guess this comes to 2.283. This is coming to 2.283. If I take it till 2 decimal places, or maybe we can take it 4. So 2.2832. And then there is also going to be a principal repayment, and the principal repayment will be discounted at the rate of 15%, and this is going to be third year end, because principal is going to be repaid at the end of third year. So let's take the discounting factor 15%. That's, I think, 0.6575 up to 4 decimals. So preferably you can take 4 decimals, but I think otherwise if you take 3 decimals or as instructed, but I think if you want to get accurate results, 4 decimal places will be a good idea. So let's see what is the financial liability element. So 500 into 6575, 328.75. I think this is coming to 442.91 lakhs. Just check the figures. I hope they are correct. So there will be no wrong. Yes, I got the answer. 442.91. Perfect. So we can take the equity as a balancing figure. So out of the proceeds of 500 lakhs, I take the balancing figure that comes to 57.09 lakhs. That is the equity element. And this will be taken in the tab number 1 of the statement of changes in equity. Now what I'm going to do, I'm going to make a ledger account 1. I'm going to show you the balance sheet extract 2. I'm also going to show you the SOKI. We're going to do all the 3 inputs: ledger account, balance sheet presentation, SOKI elements, all 3. So let's take it further. So first, let me just create a structure for my ledger account for a period of 3 years. And let me also give you the extract of the balance sheet for all 3 years. So we'll make 3 columns to show you a 3 years extract. And let's see the SOKI with 3 tabs. So we'll see the entire presentation to get the clarity of thought. So this is my financial liability ledger. This is my balance sheet extract, which I'm making for a period of 3 years. This is year 1, 2, 3. And I'm considering this is equity. So here we have got other equity. I'm not showing equity share capital, just other equity. And on the liabilities, we've got non-current liabilities, financial liabilities. And let's consider the SOKI. Statement of change in equity. This is my tab number 1. This is my tab number 2. And this is my tab number 3. Right. So I think we're ready to begin with the data. Now, first we'll concentrate on the ledger account and watch the third year very carefully, because you are going to learn the accounting treatment of the equity component of CFI through this example. Now, let's begin. So I guess, first of all, let's go back to the calculations. So you would put the entry bank gets a debit on the financial liability 442.91. So this is by bank. This is 442.91 lakhs. These figures are all in lakhs. Okay, so first let's concentrate only on the ledger account before we proceed in this particular case. Okay. So we are going to calculate the interest in this case. So would you like to give me insights in terms of what is the rate at which the finance charge will be taken? Is it going to be 10%? Or is it going to be 15? You did a discounting at 15. Now you're going to do the compounding at 15. So you're going to take interest at the rate of 15%. So on 442.91, we take a 15% that comes to approximately 66.44 lakhs, rounded off to two decimal places. Then we are going to pay the interest. The interest is paid on that 500 lakhs at the rate of 10%, and that is 50. So what you take in the profit and loss is this finance charge and not what you pay. Because you need to consider what you are supposed to pay on the financial liability. So what goes in the P&L is this charge. Let's get the balancing figure. So we take the balance CD as a balancing figure in this ledger, and that will go to the next year. So 442.91, 66.44 minus 50, I think it's coming to 459.35. So this becomes the balance in the next year. That's 459.35. Again, you consider a finance charge at the rate of 15% on this. That's almost 68.90 rounded off. You again make a payment, and that is to the extent of 50 lakhs. You get a balance CD as a balancing figure. So let's get the balance CD as a balancing figure in this case. So this works out at 478.25. That's 478.25. And now, this is the year when you need to be careful on. Last year, I'm not taking interest. You can, but just to keep the figures, keep the closure of the accounts perfect, I'm not taking the interest. I'll take it as a balancing figure. Now watch this very, very carefully. Watch this very carefully. I'm going to show you two inputs. Separately. One is because as an issuer, I do not know whether the holder will tell me to pay cash or whether the holder will tell me to pay shares. I don't know. Because the holder has got the option. So let's assume at the end of third year, the holder says, I want cash. Then what? If the holder says, give me shares, then what? So let's look at both the options. Though in the question, we are given that all the holders opted for shares. I am given, assume all the bondholders opted for conversion and shares, but I want to still show you two alternatives. I want to show you that if they want cash, then what is the treatment? And if they say, I want shares, then what is the treatment? So let's have a look that if they say, I want cash, okay? If they say, I want cash. So I'm going to pay them two things. I'm going to pay the interest, and I'm also going to pay the principal money back. I'm going to pay them the interest, and I'm also going to pay them the principal money back. So let's take the finance charge as a balancing figure just to get accurate results. So 550 minus 478.25, that works out at 71.75. And if you calculate, this should be approximately 15%. Just see. If you calculate this should be approximately 15%. Yes, it is approximately coming to 15%. If you consider on 478.25, 15%, it's coming to 71.74, which is approximately absolutely same. Wow. So this is one part of the ledger. Now, if it says no, I want shares. Let's say the holder says, no, I don't want cash. I want shares in this case. Then let's see the treatment. I'm going to pay the interest in cash, that is 50. And then I am going to give them shares for the principal. Now let's go back. When I say I'm going to give them shares for the principal, let's go back. It says out here that they may opt for conversion, and the conversion ratio is you're going to give them two shares, which are 25 cents each for every $1. If you're going to give them two shares of 25 paisa, let's call the cents as paisa. So if you're going to give them two shares of 25 paisa, that comes to 0.5 against $1. So what does this mean? That are you making them 50% payment Or are you telling them 50% principal and 50% is premium? Decide. When I told them that I'm going to give you two shares which have got a face value 0.25. So two shares, face value 0.25 makes it 0.5. So are you telling them that I'll give you 50 paisa payment for a 1 rupee? Or you're saying 50 paisa is the face value and the rest 50 paisa is the premium? We are saying the second one. We're saying the second one, though I think I got some inputs, but we are definitely saying the second one in this particular case. That's right. So in this particular case, we're going to segregate the principal and the face value and the premium. So by this way, any company taking a loan on, you said, a similar terms would have almost same finance charge irrespective of the negotiation power. Well, I guess generally, I don't deny the possibility that you might be able to ask for an interest rate equal to the interest on a non-convertible instrument. But generally, it will not be the case. But I don't deny the possibility. If you're thinking that every company will always be able to negotiate an interest rate which is below as compared to this, may not be. But yes, invariably, at least I think from the examination point of view, I like to sound safe. And I would say that if there are optionally convertible instruments, in other words, let me give you a hint on a lighter side. If the question tells you the interest rate on a similar debenture without conversion, it is indirectly telling you it's CFI. Isn't that a smart movement? Let's look at the other way around. From an examination point of view, when the question I read, it says that this is the interest on a non-convertible instrument, he is indirectly telling me this is a compound financial instrument. Because if the interest rate agreed in the question is lesser as compared to the interest rate on a non-convertible, it's a very, very direct hint, I would say, telling you that this instrument is CFI in nature. I hope you got the point. Okay, so as I said in this case, that if you're issuing two shares of 25 paisa, that means 0.5 against a 1 rupee. So we can say the rest is premium. So 50% face value, 50% premium. Now let's go back. So when it says that I want shares, I am going to divide the face value, that is 250, and we will divide the premium, that is 250. So what we have done in this particular case, we've divided this principal amount 50-50. Half of this money is pertaining to the face value, that is 250, and half is a premium. That's how the ledger accounts would look like. The finance chart, of course, remains the same. Are we pretty clear, friends, on the agenda? As far as the ledger account is concerned, then I can come to the balance sheet and I can come to the SOKI extracts as well. So I hope I stand very clear on this. And that's right. Wonderful indeed. Okay, now let's have a look in terms of the equity component. So what was the equity component? The equity component was 57.09. So this goes in the tab number 1, 57.09. This is all in lakhs. We're going to put the figures in lakhs. So the equity component enters out here 57.09, and that also appears in the balance sheet 57.09. As far as the financial liability at the end of first year is concerned, it is going to appear at 459.35. Then the next year it is 478.25, and third year it is gone. You've already converted or you've paid the cash. This remains 57.09 again in the second year. And now watch this carefully. What do you do with this equity component at the end of third year is the agenda now. Hear me carefully. The standard does not tell you what I'm about to tell you. The standard only gives you a generic sentence, but I'm giving you the practical inputs, what you need to do in this case. The money in tab number 1 will go to the tab number 2 at the end of third year. The money in the tab number 1 is going to go to the tab number 2 at the end of third year. If the holder says, I want cash, I will put this money in tab number 2 under the head capital reserve. Because now this money is become a capital gain to me. So I'm going to put this money in the capital reserve. And if the holder says, I want shares, then I'm going to put this money in terms of share premium. Wow. So it is going to move from the tab number 1 to the tab number 2 on the date of conversion. So this money will be shifted from the tab 1 to the tab number 2. If he says, I want shares, I'll transfer this money from the tab 1 to the tab 2 under the head security premium. If it says, I want cash, I'm going to shift this money from tab number 2 to tab number 1 to 2 in terms of capital reserve. So it's a internal movement within equity. If you recall, you would have done Index 16 and you would have noticed that the money goes in tab 3, revaluation surplus. And on the disposal of the asset, that money again comes into the tab number 2. And that money in the tab number 2 is again taken in retained earnings. So basically, the tab number 1 is a temporary parking. Basically, the tab number 3 is a temporary parking. The money in tab 1, one fine day goes to the tab number 2. The money in tab number 3, one fine day comes to the tab number 2. So tab number 2 is the permanent tab, which is called the reserve and surplus. So when a company issues a compound financial instruments, the money which is the equity component is resting in the tab number 1. On the date the conversion takes place, or on the date when the issuer says, give me shares, whether it is cash payment or shares, the money in tab 1 goes to the tab number 2 under the appropriate column. So as I said, the appropriate columns are capital reserve. If he says cash, it is security premium. If he says shares. Got the connect, I guess, on the treatment of the equity component of a CFI in terms of things. So which means that this money still remains in the other equity, except that this money was lying in the tab number 1 earlier. And this money is now shifted to the tab number 2 in this particular case. It's an internal movement with an equity. Wonderful indeed. I think this question would have now given you the insight of how things are presented in the balance sheet. The liability element is presented separately. The equity component is presented separately. The liability keeps moving and the equity remains as it is. Okay, so I hope, friends, am I clear on the agenda? I hope the clarity is working 100% at this stage, not even 99. You need to be 100% clear on the agenda in terms of how the accounting and the presentation is done in the financial statements. Okay, so far so good. 10 by 10. Perfect. Wonderful indeed. I think that's going good. So that's right. Okay. To remind you, I've done 2 cases. So I think what I need to do, friends, I need to put this is my case number 2. Remember, we're going case by case on the CFI. I think I've got a good homework to do with you in the next session, where in the morning, I am going to remind you of the mind map which I done today. So this is case 2, which is a case of optionally. It's a case of optionally convertible financial instrument. So this is a case number 2. We did the case 1, which was perpetual debt. And this is a case number 2, which is optionally convertible instrument. So we've seen 2 kinds. We've seen 2 kinds. And this is optionally convertible. And this is at the option. It is at the option of the holder. It is at the option of the holder. And in this particular case, we said that the option has equity characteristic. It has got equity characteristics. And since it has got equity characteristics, it is not segregated as well. Now you'll start asking more in life. So why don't you do a question to me where the CFI is got an equity, where it's got a derivative, it is FL in nature. How would you do that? There is no question available, I guess, on that. I think in most of the questions where there is an option to convert, the option to convert becomes equity in nature and it doesn't get segregated. There's no dearth of doing a PhD on that. where you start looking into various inputs in terms of that, okay, if this derivative is equity, what is the treatment? If it is derivative and it is financial liability, then what? Blah, 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 blah. We're not getting into that. Okay, so this is done. Now let's come back, friends, on the study material. Back to you. So we were technically discussing the illustration number 29. I did not do illustration 29. I jumped to another question with you. And I wanted to do something similar because I wanted to tell you the segregation of that, share premium and capital reserve. Now let's come back on the illustration 29. So in this case, the consideration is 10 lakhs and there is an option to convert to fixed number of shares, and the preference shares carry a fixed dividend, fixed coupon rate of 6, and the conversion is 9. Now we can just see the treatments given. The proceeds in this case is given. So we've taken the present value of the principal at the end of third year. That's 1. The present value of the interest, that's 2. So we get the total financial liability. And the balancing figure is equity. And in the subsequent years, the P&L is taken at the rate of 9%. So I think I've given you the entire details as well. Do you want me to make a ledger account for this, or I think it's manageable? With the question we have done, you want me to do this illustration, or I think that's manageable? As you wish. You can ask me, I can do that. If it is manageable, we'll skip that. So tell me, you want me to do this illustration or similar skip? Okay, so I think I might get the answer skip. Okay, this is 100% clear. Wonderful. And I get the answer, yes, we can skip this. I think everybody says it's manageable now. Wonderful indeed. Let's now go to the next level. Now, there are 1 or 2 interesting questions on the concept of CFI. As I said, I'm looking at, partially convertible. I'm also looking at a case of mandatorily convertible. So these illustrations are there in the study mat. Then apart from this, they've given some illustrations in the end. There is a chapter which talks about the illustrations on FI. So what I've done, I did not load that part out here. So what I've done, I've just, taken those illustrations also. So I am going to take you to an examination question in this case. So I picked up an examination question number 2. This is November 2019, and that is 10 marks in the exam. So let's have a look at this particular question. This is November 2019 examination question. So we're going to look at this particular question to get more clarity of thoughts in life. So let me just read this question now to you, and we'll see what is this particular case. So it says we issued a convertible debenture on 1st April 15, and the debentures are due for redemption on March 19, 4 years, at a premium. It says at a premium of 20%. It's convertible into equity shares to the extent of 50%, and the balance is settled in cash. 50% is in terms of shares and 50% is in cash. Nowhere did he say that this is an option. He only said 50% shares and 50% cash. So we can say this is a case of partially convertible debenture. Now let me, keep giving you the chain, friends. We're working on different cases of looking at questions on CFI. The first one we looked at was perpetual debt. The second one we looked at was a case of optionally convertible instrument. The third one we're looking at is a partially convertible instrument. The next one we're going to look at is mandatorily convertible instrument. And we need to be careful on the accounting of each of these combinations, A to Z, pin to point. So it says 50% is convertible in shares and the balance is in cash. The interest rate on the equivalent debenture without a conversion is 12. The conversion to equity shares qualifies fixed for fixed. So can I say the option? Can I say the option is being called as equity? So will you segregate two elements or one, three elements? Are you going to segregate the FL, equity, and derivative FL, or just FL and equity? If the fixed for fixed test is passed, it becomes an equity characteristic. And if it becomes an equity characteristic, then we are not segregating the derivative out of this, correct? Super. I think that's going good. That's right. So we're going to segregate the two elements in this case, and that's rightly identified. Okay, let's go further. You're required to separate the debt equity components at the time of issue and show the entries at initial recognition only, and the following present value of 1 rupees are given. We just asked for the accounting at the initial recognition. Do you want me to show you the recognition at a later date as well? Do you want me to make the ledger accounts for a period of 4 years? You can say no. I will easily listen to you. So it says that we want the accounting of the initial recognition. So you want me to just do the split accounting at the beginning and go off? Or you want me to do the ledger accounts for a period of 4 years, get more clarity of thoughts in life? You can say a no. I don't mind. I'll restrict myself. I don't think so. You're going to say a no on that. Everybody's going to say, I want 4 years in this case. But not many people said we want 4 years. I think the minority is wanting me to make 4 years. The majority wants me to just do the initial recognition. Sometimes it's good to hear the majority, no? Okay, so let's go ahead. Let's first do the split accounting in this particular case. Okay, I get another input as well. And somebody says, give me a question. You said, so since it is saying convertible, we assumed optionally convertible and not mandatory. Well, in this particular case, when it says that 50% is going to be converted to equity shares, I believe it is partially convertible, but you can say, yes, it is indirectly optionally convertible to the extent of 50%. But in this particular case, I'm not saying that it is optionally. Otherwise, my calculations will get wrong. Now, you'll see that inputs very shortly why my calculations will go wrong. Because if it is optionally convertible, then in that particular case, my obligation, please hear this very carefully. If you say it is optionally convertible, my obligation is unavoidable to the extent of full principal money. But in this case, when I'm calculating the financial liability, considering that 50% is going to be paid in shares only, my financial liability is the unavoidable obligation to pay cash. My financial liability will be only 50% of the principal, considering that 50% is going to be paid in shares only. So they're going to issue fixed number of shares. So in that case, I will not take that element in my liability. So I would say it's partially convertible, that 50% is not optional, but it is supposed to be indirectly, you can say mandatory indirectly. Got the point? Okay, so let's work on the solution. Let's work on the answer. So we are first taking the proceeds in this case. Let me go to the proceeds. So we have issued 80,000 debentures of 100 each. So let's take the proceeds. It is 80,000 debentures and the proceeds are 100 each. So this works out at 80,000 into 100. That works out, I guess, 80 lakhs. So we need to segregate the financial liability and the equity component. So let's see what is the financial liability, and then we'll take the equity component as a balancing figure. So we've got to pay what is to be paid in cash. Let's see. So we need to pay the balance 50% in cash. And it also says that you're going to redeem the debentures at a 20% premium. So let's first take the interest. The interest in this particular case is paid at the rate of 8%. So my financial liability is on 80 lakhs. There will be 8% interest, and this will be discounted at the rate of 12% for a period of 4 years. My rate of interest on a non-convertible instrument is supposed to be 12%. So we're going to discount things at the rate of 12%. Okay. So now, and also the principal. Now, as far as the principal is concerned, so we need to pay only 50% principal in cash at a 20% premium. So let's take it as 120%. So this is going to be discounted at the rate of 12%. That is fourth year end. So there are two elements of financial liability. One is the interest paid every year, and one is the principal, but only 50%. Notice we're taking 50% principal, and that's also payable at a 20% premium. So we are liable. Our unavoidable obligation is to pay the 50% principal in cash at a premium. So let's see at 12%, what are the factors? 2, 3, 4. That's 0.6355. This is 0.6355. And this is 3.0373 up to 4 decimals. So let's see what is the financial liability element. So this is going to be, I guess, 80 lakhs into 8% into 3.0373. That's 19.43, 19.44, we can take it. 19.44. I think it is coming approximately around 49 point something. Just check the inputs.
56 lakh.
Yes, but I think the discount rates are already given, so I think we should take that. So 12% is 0.625. It's slightly different from what I've taken, but we'll abide by the question. We'll abide by the question since it is given 0.625. I think we'll take it 0.625. And let's also take the cumulative from the question itself. Let's take the cumulative of 4 years, 887, 788, 701, 625. I think it's 3.001. So as per the instructions in the question, I'm abiding by the discounting factor. So let's see what is the figures coming in this case. This is 80 lakhs, 8%, 3.001. This is, I think, coming to 1920, 640. And this is, I guess, 40 lakhs into 120% into this. I think this is coming to 30 lakhs. So we can get the sum total of this. It's 49 lakh, 20,640, I guess. That's what the figure is coming. So we can get the equity as a balancing figure in this case. So out of 80 lakhs, 49,20,640, this comes to the balancing figure 30,79,360. So you want me to make the ledger account for the period of 4 years or no? Or this is fine. Then I think if not, then I can ask you a question at this stage. If yes, then I'll make the inputs. You want me to make a ledger for 4 years? Majority votes. Okay, the answers, these were the calculations, I guess. And okay, so somewhere we've taken that 12%. 12% we have taken from the question itself. It says that the rate of interest without conversion is 12%. So we're taking the 12% from here. So you want me to make the ledger account for 4 years? What you said, yes, I think I should assume that to be no. Why should I have a constructive obligations in life? Okay, skip. That's fine. Then it's okay. But I have a small little question to ask you. When you are going to make a ledger account for the financial liability, will any allotment of shares takes place to that account? My question is very simple. When you're going to make a financial liability ledger at the end of 4th year, will the ledger contain any allotment of shares in the 4th year? Say yes or no. Once you complete the 4 years ledger, are you going to see any allotment of shares? Like the previous question, are you going to see any allotment of shares in the 4th year ledger? Say yes or a no in this case. So I'll get my inputs. And I get the answer yes, I get an answer no. So I think majority seems to be saying a yes or no blended. Many people are saying a yes, and some people are saying no. The answer is no. The answer is no. Your allotment of equity shares will take place through the equity balance which you've got. So once you make the ledger accounts, no allotment will take place. This money at the end of the year. So let me, I think, at least put that across to you. So this money, you can say this money is will segregated in terms of equity share capital and in terms of share premium at the end of fourth year. So at the end of fourth year, this will get split between the two. Now, moral of the story, in case of optionally, please hear this carefully, in case of optionally convertible debenture, the entire amount in tab 1 goes to the premium or capital reserve. Aha. I'll make that comparative chart later in the next class, not today. Now, if it is supposed to be partially convertible debenture, the money in tab 1 does not entirely go to tab 2. Some portion, which is the face value, goes to the equity share capital, and the remaining portion goes in the tab number 2. Is my thoughts correct? So when it is a case of PCD, not the entire money in tab 1 goes to the tab number 2. The portion which is equity share capital goes in the balance sheet, and the portion which is premium, that goes in the tab number 2. Not the full amount gets shifted, remember. So you need to be careful that what element of the tab 1 goes in tab 2, not the entire element. I hope, friends, you got the perfect inputs correct. I thought maybe you would have asked me to make the ledger accounts to get more clarity. So could you please explain this part again? I just gave the offer and people rejected my offer. I said I'll make a ledger account for 4 years and people said, no, we don't want it. You can think, when I'm asking you something, I'm expecting the answer yes. Let's put the question once again. You want me to make the ledger for 4 years? Now say no. Because I knew that this could create a point of confusion. And now people will say, so I said a yes on that. Okay. Now we're getting yeses on this part as well. So no. So yes. I'm making it, friends. I think for giving you better clarity of thoughts in life, let's do one thing. Just hear this. It won't take much time, but you need to get the clarity of thoughts. I tell you one thing where people go wrong. Sometimes due to lack of time, or sometimes due to too much of a pressures in mind or whatever, you feel no, this is okay, I don't want to see it further. Unless you go ahead, you'll never get conceptual clarity. So don't stop yourself from learning in life. Don't stop yourself. Go ahead, dig it further, try to find out more details. Let's make it. It's going to take just a few minutes. What's the big deal? Let's make the ledger account for this. Let's not make a balance sheet, but let's make a SOKI. Let's definitely create a SOKI so we can get the details, not a balance sheet. So this is going to be my statement of changes in equity. This is tab number 1. This is my tab number 2. And this is my tab number 3. And let's make the financial liability as well. So we're going to record this figure, that is bank. Let's come back. So this is 492640. 492640. So you're going to take the finance charge quickly at the rate of 12%. 1 year, 2nd year, 3rd year, 4th year. So we're just going to make quick ledgers on this. So this is going to be 492640, 12%. That's approximately 5904.77. You make a payment, and I think the payment we're making, the coupon rate was how much? So we're making a payment to the extent of 8%, 640,000. So the payment is being made 640. So you get a balance CD, balancing figure. Then again, take the finance charge on this. 492640 59047 minus this is 4871,117. 4871,117. 12% would mean 584534. You make the payment again 6,40,000 and you get the balance CD. That is the balancing figure. So 48711, rather 1117, 584534, and this comes to 4815,651. 4815,651. We again take the finance charge at the rate of 12%, 5778, and this is 78. Then again we make the payment of 640, get the balance CD as a balancing figure, and again we take the finance charge. Last year I will take the finance charge as a balancing figure to close my leisure. So 4815,651, 577878, and this comes to I think 4753,529. So 4753,529. Now tell me, what are you going to pay in the last year? You're going to pay the 6,40,000 and you're also going to pay 50% of the principal with a premium. Remember that 80 lakhs into 50% with a 20% premium, that's 48 lakhs. So this is 50% of the money. Now you can take comfortably the balancing figure. That is the interest. And that works out at 686471. Though I'm pretty confident that this will not be equal to 12%. I'm pretty confident this will not be equal to 12% because I think the PVI factors, as per the question, seems to be a little deviated. Anyway, it should be approximately coming to 12%. See, is this coming approximately? I don't see it'll come. I don't see it'll come, but it's okay. As I said, the present value factors given in the question are very different from the actual ones, so you will not be able to reconcile. But anyway, let's not get into that. So the ledger account gets cancelled, the finished in the stage. Did I make any allotment of shares to the remaining 50%? No, I did not. So what are you going to do now at this stage? Watch this. Watch this, what I'm going to do. Can I say you recorded the equity component, that is 30,79,360. 30,79,360. That was the equity component rested in the tab number 1. So this money is now going to be split between the allotment of equity share capital and the security premium at the end of third year. Because this is the money through which the allotment of 50% shares will take place. In terms of optionally convertible, this money is lying with me. Now, whether the conversion takes place in cash or shares, when you took the financial liability, you took the entire principal. Please relate that. When you took the optionally convertible debenture, you took the entire principal as a liability. So whatever was the difference between the interest rate on a non-convertible and a convertible instrument, which is going to be with me in tab 1. But in this case, when you took the financial liability, it contains only 50% of the money. If it contains 50% of the money, that means the remaining 50% which is going to be paid in shares. So you'll split the face value out here in terms of the equity share capital at the end. And this is the balancing figure. So this is the only money which will go in the tab number 2 on the date of issue of shares. I hope, friends, now you get a complete clarity of thoughts. I want to say 3 sentences now at this stage to give you more clarity of thoughts in life. Let's give you more clarity. In the agenda number 2, I started with perpetual debt. I took that money in terms of tab 1. It remained there. It remained there. I did not touch it. Recall. Next, I went to optionally convertible debentures. The money went in tab 1. It did not remain there forever. On the date when the holder said shares, it went to share premium. When the holder said, I want cash, it went to capital reserve. Number three, we've seen partially convertible debenture. So in terms of partially convertible debentures, can I say the money went to tab number one? It pushes off, but it gets split between the face value to the share capital and only the excess, the premium goes to tab two. So in terms of perpetual debt, it remains. In terms of optionally convertible, it goes to tab two fully. Capital reserve or premium. In terms of partially convertible, it gets transferred partially to the tab number two to the extent of premium only. Now, tell me, did you get more clarity of thoughts in life? I'm sure you would have. Okay, let's now go further, friends, with you. So I think this must have given you more clarity of thoughts in life. That's great. Super. Yes, I think Ayush has put his hand up. Yes, please go ahead, Ayush.
So, sir, basically, we are saying that in case of partially convertible debentures, this case, the equity part has we have to split that
Correct.
in a version that we can say that earlier, the last question, the whole equity was either share premium or capital reserve. In this
Correct.
next version, this whole equity contains the what we are assumed that 50% people would be allotted equity shares, so that part, that 30 lakh 79,000
Correct.
already contains their face value, so we have to
Correct.
at the end split it.
Yes. So can I just ask another question to any all of you, of course, but you can answer that. So if it is, let's say, mandatorily convertible debenture, can I say again this technique will happen?
Yes, sir.
Correct. So which means now we've got a clarity of thought that if it is optionally convertible, the entire money in tab one goes to tab two. If it is partially convertible or mandatorily convertible, it's going to be split between the face value, equity, share capital, and the excess premium. Great.
Yes, sir, thank you.
You're most welcome. Okay, so I think let's now go ahead and let's show you another question as well. So this is the next agenda. This is the next question to you. And this is came in mock test papers, and this is on mandatorily convertible one. And let's have a look at this particular question as well. Let's see the question number three. It says a company issued compulsory cumulative convertible preference shares, CCCPS, compulsory cumulative convertible preference shares. The rate of dividend is 10%. The preference shares are convertible. Are convertible means what? Mandatory. Compulsory is mandatory, are convertible into 5,000 equity shares at the end of fifth year from the date of allotment. When the CCCPS are issued, the prevailing market rate for similar debt without conversion is 15. So we are paying a coupon rate of 10 and the interest without conversion is 15. And this time we're also given a transaction cost as well. The idea of doing this question is to explain the treatment of TC. The idea of doing this question is not to tell you how the split will be done. You know the split. The idea is to tell you how the accounting for the TC will be done. It's 2% of the proceeds. Now I am given the total period in this case is 5 years. And we're given the number of preference shares, the face value, the proceeds, the dividend rate, and the market rate is given, etc., etc. Show the entries in this case. Now, friends, I am going to give you a little technical discussions in the next couple of minutes as well. You know, I had a choice of taking two questions. One question was where, because of the TC, some new data is given. And one was that because of the TC, the new data is not given. So I wanted to pick up a question which was more technical in nature. So right now, in the next 5 minutes, you might start feeling more heavy. It's okay. It's okay. The idea is to learn the concept in detail. So let's do now a little discussion with you. So did I mention this was case 3? I think I want to mention this. So let me please also make a mention out here. This is case 3, partially convertible debentures. That becomes my case 3. So I'm now putting the case number 4. So before we discuss the case 4, I have more to discuss. This is compulsory convertible debenture. So when you revise today, please revise it with the complete perspective. Perpetual debt, case 1. Optionally convertible, case 2. Partially convertible, case 3. Compulsory convertible, case 4. You need to get a complete clarity of thought. In all these cases, what is the portion which is taken in the split accounting for a financial liability? Next time when I make a mind map, I'm going to create a mind map on a very simple level, telling you that what are the FL elements under each one of these combinations. And now we are not dealing with this case right now. I am dealing with a little special issue right now. I am dealing with a little special issue right now. So this week, keeping it aside, so this is covered later. I'm just discussing a special issue, and that is the treatment of TC. The treatment of transaction cost. We're putting it as TC in case of CFI. So my idea of discussion now is to give you the treatment of a transaction cost in terms of CFI. Now hear me very carefully, friends, because I am going to give you the technical inputs of what is to be done. So watch this very, very carefully now. I'm just going back to the question. So I am given that in this particular case, the company is raised in how much money? The company is raised in 10,000 shares, 150 each. What is the proceeds? 10,000 into 150, it comes to 15 lakhs. So I'm looking at the proceeds, that is 15 lakhs. And I want to segregate that out of this, what is the financial liability and what is the equity component. So let's go back to the payments. Now tell me, in this particular case, when the principal will be converted into 5,000 equity shares, are you going to consider in the financial liability any principal element or only the dividends to be paid for the next 5 years? What do you say? So in this particular case, when you are considering the financial liability, my unavoidable obligation to pay cash is to the extent of the dividends for the next 5 years. Can I say no principal? Because the principal is going to be discharged in terms of fixed number of shares, and that's not the financial liability element. Correct? So I am going to consider in this particular case only the dividends. That's absolutely correctly said. So let's go to the dividend. It's at the rate of 10%. So let me do the calculations. So on this 15 lakhs, we're going to pay a 10% dividends. And this will be discounted at the rate of 15% for a period of 5 years factor. So let's see the factor at the rate of 5%. Are we given the factors by any chance? No. So we can work this out. So this is going to be 15%, 1, 2, 3, 4, 5. So cumulative is coming to around 3.35 to 2, rounded off to 4 decimal places. So this is going to be 1,50,000 into 3.3522. So this is coming to 502,830. So you take the equity as a balancing figure in this case. So we take the equity as a balancing figure. So this works out at 997, 170. This is the split. Now, the logical input, what we need to consider in this particular case. The logical input, what we need to consider in this particular case. The company incurred a transaction cost. Was this transaction cost incurred in raising this entire 15 lakhs? Yes. That means the money is spent in terms of raising both the liability and the equity. And the wonderful part is the transaction cost related to equity has got a different treatment, and the transaction cost related to FL has got a different treatment. So it is necessary that the transaction cost is split between what relates to the equity and what relates to the FL. So in this case, let's go back. The company is issued a 2% transaction cost. So if you consider what is the transaction cost on 15 lakhs, the company incurred a 2% transaction cost, and that works out at 30,000. But as I said, the treatment of this 30 is not same. What relates to equity is got a different treatment, and what relates to equity is got a different treatment. So what we need to do? At this stage, at the first instance, we need to divide this 30,000, that how much of this transaction cost relates to equity and how much relates to the financial liability. So we will split this between the financial liability and the equity. And this will be split in this ratio itself. We're going to split the transaction cost in this ratio itself. Right now, I'm just giving you the treatment of a TC at the inception. We also need to see the treatment on a subsequent level as well. So in this particular case, once you get the split accounting, you need to divide this transaction cost between how much relates to FL, how much relates to equity in the ratio of this money. Let's divide this. So 30,000 into 502,830 upon 15 lakhs. So I think this is coming to 10057 approximately. And this is coming to 19,943 approximately. Now the question rises, what is the treatment of this transaction cost? The amount of TC related to financial liability will be netted off against the proceeds. The amount of TC, watch this carefully, the amount of TC relating to the financial liability. I cleared this. This is 30, sorry. So the amount of TC related to the financial liability is going to be netted off. So this is going to be netted off. So when I'm going to make my financial liability, the amount of TC is going to be netted off against the financial liability. And the amount of TC relating to equity is going to be charged to equity itself. It'll be charged to equity itself. So when I say it is going to be charged to equity itself, it is going to be captured in the retained earnings directly. It is not going to be taken in terms of P&L. So this expense is going to be adjusted and directly taken to SOKI, adjusted against the retained earnings. So moral of the story, let me just connect the dots. As I said, we're dealing with the case for later. The idea right now is to just give you the treatment of a transaction cost relating to compound financial instruments. Let me just connect the dots. So when you see that there is a transaction cost relating to a compound financial instruments, forget about it at the initial. At the initial, forget about it. So what you need to do, you will take the proceeds as usual, segregate the FL and the equity. Don't even think about a TC at the initial stage. Once you have segregated the proceeds in terms of FL equity, then sit down and segregate the transaction cost in terms of FL equity in the same ratio, which is the split accounting done. The TC relating to financial liability will be netted off against FL, and the TC relating to equity will be taken in the SOKI retained earnings directly. Now, how is this going to impact the accounting for the financial liabilities subsequently? That is what we're going to discuss in the next agenda with you. My discussions on CFI is not completely done. I am yet to discuss this issue. And then there is another special issue coming in, which is the early redemption of the compound financial instruments. Wow. So that adds another data points to your mind. So I think, friends, that seems to be a bit heavy, getting heavier day by day. Third session. So what are the expectations? That before the next class, cumulative revision of the first, second, and third. And I'm going to make my mind maps in the next class with you on this area. So I think ma'am has also joined. So any question, friends, on your side?
Okay. I'm finding, sir, since this is a very technical topic, still I know that you will make it interesting also with your mind maps. So students, I'm finding the participants have increased today. Again, Saminath and Geeta, they have joined back to our LVC classes. Good. So, in case students you find any other issues, you please let to know. Be interactive with sir. Sir will help you in clearing each and every doubt for related to this topic and the topic which he has taken earlier, whatever it is. So be ready and come prepared. As sir told, he just revise whatever the topics he has discussed in previous two classes so that you are able to grasp it, because pending work will increase your pending pile. It will increase the pile. So don't go for that. Just be regular and consistent for especially for this topic. Okay. Any other queries, students, you want to post, you please let us know. We are here to resolve it. Anything anybody wants to know? Leela, Manish, Saminathan, Ayush, Bibhu, Sanjay, Geeta, and Neha. Any query you have?
No, ma'am. Thank you so much, ma'am.
Okay, Manish, thank you. Geeta, thank you. Anyone else wants to ask something? Please let us know. Otherwise, we can wind up the session.
No, ma'am. Good morning, ma'am. Actually, sir is explaining each concept is very clearly,
Mhm.
and with giving all the examples in layman language. It's very clear and useful.
Good, Saminathan. And we always find that you are a very regular and punctual student, and hope you'll find the benefit from this in your results. Also, you are going to appear for this January examination, na?
Yes, ma'am.
Okay. Okay, students, all the best. And in case you have any query, you can write to us also at your in your WhatsApp group also, and also to us on our mail, bus@ica.in. Okay, thank you everyone. Thank you, sir.
Thank you so much,
Thank you,
ma'am.
ma'am. Thank you, sir.
Thank
Thank
you
you,
very
ma'am. Thank you,
much.
sir.
Thank
Thank you
you.
very much, all of you.
Thank you, sir.
We'll
Thank you,
see you in the
ma'am.
next session. Please revise. We'll see you in the next class. Thank you very much. Bye bye and take care.
Bye. हाँ जी
Thank
यशु जी
you.
बंद कर दें.